Ahora ya ha llegado James McCormack, no lo veo por acá, pero me dijeron que está. Ahí está. Bueno, entonces lo vamos a invitar. James, you're invited to the floor.
Perfect. Thank you very much. Good morning, everybody. When I knew I was coming to Argentina, it was maybe two or 3 months ago, and I thought, well, I don't really have to talk about Argentina this time because I can just talk about what's going on elsewhere in the world. But things change quickly, I guess, in Argentina, so I'm going to have to make some comments about what we've done. As you know, we downgraded Argentina last week by 2 notches, so I will come to talk about Argentina at the end of this presentation. But for the most part, this is really a presentation about what we see going on in the global economy and in the world of sovereigns. And I apologize for my attire, but I just came from the airport, so usually I would be a little more respectful of the audience and dress properly. Another point is that I would like to make this presentation available to everybody. So we have a PDF file. Maybe get in touch with the office here. We'd be happy to send out this presentation to you. So keep that in mind as well. And lastly, I'm open to questions and comments. So at the end, if you want to talk about anything further or you disagree with anything or want to propose a new topic of discussion, more than happy to do that. So are they all going to change? Okay, perfect. So this is the content of the presentation. I'm just going to give you a couple of big picture issues that we're looking at. Global economy, you have to talk about the US and China when you talk about the global economy. I'm going to talk a little bit about ratings, not that much about the rating profile, but give you an idea where we think ratings are going to go for the rest of this year and into next year. China-US trade war, every presentation we've done for the last year has really talked a lot about China and the US, and I'll give you our thoughts on where we think that's going to go. Political and geopolitical risk. You know, this used to be something we could talk about from time to time in some presentations and skip it in others, but now it's in every presentation. We have to talk about politics. And then at the end, Latin America, sovereign rating history, and I'm going to talk to you a little bit about specifically about Argentina and what we've done here, why we did that, and what we think is going to happen next. So here's a big picture schematic of the issues that we're looking at. And on the left-hand side, this is our assumptions and what we think is going to be, what we think is happening now, what we think is going to be happening in the future. And so I'm going to talk about the global economy, global macro policy, and global capital markets. And it's useful to think about those 3 things a little bit separately. So in terms of the global economy, clearly things are slowing down. There's no disputing the fact that things are slowing down almost everywhere we look. Primarily in Europe, that's definitely the weak spot, but you see it in the US and China as well. And we think the risks really are clearly to the downside. We're not expecting any positive surprises, but we could clearly get some negative surprises. In terms of the macro policy outlook, that weakness in growth is putting a lot of pressure on policymakers. Primarily on central banks, because central banks came to the rescue in 2008 and 2009. And so there's an expectation in the market, and there's an expectation amongst fiscal policy officials that central bankers can do it again. They can help us through this again. So a lot of pressure on central banks. I think that's going to spill over into public finances, and we're going to see fiscal deteriorations as well going forward. So all macro policy levers probably going to be used if they're not being used already. Global capital markets. So really, there's only one thing I want to talk to you about here, which is negative interest rates. So I've got a chart here on that I'll go through on negative yielding sovereign debt, which really tells you the world is kind of upside down when you can issue debt and pay back a nominal amount later, less than what you issued. So it's very bizarre to kind of wrap your mind around that debt is issued with negative yields and an increasing amount of it. And I'll talk to you about how we think about that. So what are the big risks? Number one risk, and we've had this in every presentation since Donald Trump was elected, number one risk is trade policy, and it hasn't gone away. If anything, it's getting worse. And I'll talk to you about what we think is going to come next, specifically around the China-US trade dispute. The dollar, as you know, or as you may know, in all the presentations that I do, I tend to talk a lot about the value of the US dollar being the biggest single risk for emerging markets. Nobody knows that better than an audience in Buenos Aires, but it's true in every emerging market. The dollar is the #1 risk, and that's not changing, and I'll talk to you a little bit about that. And then at the end, sure, politics and geopolitics, there's a couple of different countries to cover. So here's our global economic forecasts. On the right-hand side, that table is what we put together in June. And we do a quarterly update of this. Quickly, as soon as we put that forecast out, the trade war got a little bit worse, and we had to start thinking about the imposition of additional tariffs by the US on China. So the little box at the bottom, which shows you different global number, a different number for the US and a different number for China, those would be the forecast for 2020 if the US imposes the additional 25% tariffs on all imports from China. We didn't have that in our forecast. We didn't think that was going to happen, but then the president announced the 10% on everything. So you have to think that the forecast is somewhere between the little gold box at the top and the little gold box at the bottom. So clearly growth pushing lower, including in the US. So it's US imposed tariffs, but the US growth impact is meaningful. From a global perspective, it goes from 2.7% to 2.3%. So, what's 0.4%? In terms of global income, that's more than $200 billion of lost income. So it's quite significant for global growth to go closer to 3% and now closer to 2%. So we're saying that it's not a recession, not yet. And the reason I would say that is we don't see clear evidence yet of the US going into recession. We can talk a little bit about the yield curve and how useful that is, the inverted yield curve. But I'm going to show you a couple of charts of things you should watch more carefully to determine whether or not the US is actually going to have a recession. In China, growth is clearly slowing, but the authorities are determined, absolutely determined, to have growth of 6% this year and 6% next year. So come what may, whatever happens on the trade war, we believe that the Chinese officials will try extremely hard to deliver that growth number. It's got to do with a commitment they made back in 2012 to raise their income levels between 2010 and 2020. They wanted to double their income levels. To achieve that, they need to grow by a little bit more than 6% this year and next year. So we think they will, which means they're going to use any kind of stimulus they need to. And there's a rating implication there, and I'll show you a chart on that. So the numbers on Argentina that I put in here, minus 2.5 last year in actual, and then a forecast for this year of minus 1.7. We've adjusted that already. So now for this year, it's minus 2.5 as well. So that was an adjustment that we made last week. The only other thing I will point out in this chart is that we have a different view than the market on US interest rates. We believe the US economy is still reasonably strong enough that we don't think the Fed is going to continue to cut rates the way the market believes. So we've got one interest rate cut in the forecast, and we think they hold from there unless the economic outlook deteriorates further, which we don't anticipate, but it's a risk. So we've got a different view than the market on US rates. So here's a couple of things to look at in the US economy. So if you are bullish on the US economy, the chart you want to show your friends is the one on the right-hand side, because that's looking at consumption growth and households. So the argument goes like this: the labor market in the US, no matter which way you want to look at it, the unemployment rate or wages or whatever, the labor market is fundamentally strong. So household income is fundamentally strong. So consumption growth remains quite solid, and consumption is 2/3 of GDP. So how can you have an economic slowdown if the household sector is still doing fine, right? So that's the argument. The chart on the right-hand side shows you the blue line is real consumption growth, and it's around 2%. That's pretty healthy. So that's 2/3 of the economy growing at 2%. No recession there. If you're bearish on the US economy, the chart you want to look at is the one on the left. So that's showing you investment spending. Investment spending, I went back and looked at every recession since 1950 in the US. There have been 10 recessions since 1950. In every single recession since 1950, investment contracted. So investment on a year-over-year basis declined. So how close are we to having a decline in investment spending in the US? And every time investment spending declined, there was a recession. So it's a perfectly correlated number with recessions. So what this is showing you on the left is investment spending and investment intentions. So this is a survey. One of the Federal Reserve banks, it's the Fed in Philadelphia, asks the manufacturing sector, what are your investment intentions? And what that chart is showing you on the left is that the intention, which is the green line, the blue line, was actually up at record highs just after Donald Trump was elected. So the business community loved what they heard from the Trump administration. Lower taxes and less regulation. Companies liked that, so the investment intentions went up. And investment spending started to pick up as well. Then the trade war began to materialize, and the intentions and the optimism in the business sector started to come back down again. And that is showing, that is being reflected now in actual investment spending, which is slowing down. It's not zero, so we're not in recession territory, but it is slowing down. So if you're bearish on the US economy and you think there's going to be a recession, that one is definitely the number to watch. So we're kind of in the a little bit more optimistic camp, but if the trade war continues to deteriorate, then the investment spending we think could go into, could turn negative year on year, and we could be in a recession. So, oops. Right, okay, so the next two charts are on China. So what do we think is going on in China? China is really all about credit growth. The economy grows when credit grows. And on the right-hand side, that chart is showing you the broadest measure of credit growth in China. And it is back in positive territory, right? So credit is growing again. And in fact, it's growing faster than nominal GDP. So the economy is leveraging up again, which from our perspective, from a rating perspective, is negative because we think debt levels are already high in China, and continued growth of credit is putting at risk some macroeconomic imbalances, particularly in the corporate sector. So the banks are very, very large in China. They're leading this credit growth, and so we think more and more imbalances are being created for the future. But as I mentioned, the authorities are determined to grow by 6%. So if they need to crank up credit, they will. But it does present some risks for us to think about. The next chart shows you something which I think is probably one of the most underappreciated facts in China now. The biggest change in China in at least the last decade is the fact that the current account surplus, which we used to be accustomed to being extremely large, is disappearing. There is no current account surplus anymore. The chart on the left is showing you the current account position, and it went up a little bit in the first quarter of this year, but we think it goes to zero and into negative territory. China will be running a current account deficit in the not too distant future. Why is this happening? Well, it's not because of the trade balance. The trade balance is the blue bars, which are still positive. So China is still very competitive in terms of manufacturing exports, runs a big trade surplus. It's the services deficit, the green stuff below. So China is running a big and growing services deficit. Well, what is a services deficit? People can wrap their mind around trade flows, but service flows are a little harder to understand. The easiest way to think about what this services deficit is when you go on holiday, wherever you go, you're probably seeing a lot of Chinese people there as well. So China's tourism deficit is large and growing. So that means Chinese citizens leaving the country, spending money outside of China. Believe it or not, that finds its way into the current account position. So that, we think, is only going to grow as the middle class in China grows. So the services deficit getting bigger is going to put the country into a current account deficit. Why does this matter? Because China used to be, with that current account surplus, a net supplier of capital to the rest of the world. It was either buying US treasuries when it was growing its foreign exchange reserves, or lending money out through the Belt and Road Initiative or some kind of foreign direct investment, but money was leaving China and kind of flooding the rest of the world with cash. That's over. That is definitively over. So what is going to be happening going forward is that China, like any other emerging market, or many other emerging markets, is going to be looking for capital. China is going to be competing for capital imports like any other emerging market that is running a current account deficit. This is a very, very big change, and Chinese government officials are cognizant of it, they're aware of it, and they're worried about what this means for capital flows, what it means for the stability of the exchange rate, and a number of issues that they have not had to deal with up until now. So I think that's something to definitely keep an eye on going forward. So the next, I'm going to talk a little bit about ratings. So where are we in the rating cycle? So this chart on the left is showing you the rating changes that we've had over the last 12 months. That's the blue line. And you can see to the right-hand side, that blue line is still above zero, which means we've had more upgrades than downgrades. So that tells you we're in a positive part of the rating cycle. But the green line is net positive outlooks. And the net positive outlooks is in the negative territory, which means we have more negative outlooks than we do have positive outlooks. And on the right-hand side, it says 19 negative outlooks, 12 positive outlooks, so we're at -7. So if you think the outlooks are going to tell you where the ratings are going, the ratings are going down. And you can see that, you know, we had an uplift in ratings in 2018. We were at a positive part of the cycle. That cycle is changing. So we are now moving into a period where ratings are going to be coming down. So we think that that blue line, which is above zero, is going to revert to being below zero. We're going to see more downgrades for the rest of 2019 and into 2020. The next chart will show you, so on the left-hand side, this is, again, negative and positive outlooks. So that red line is the 19 minus 7, so we're at 19 minus 12, so the red line is at -7, so same data, just showing you how many we have on negative, how many we have on positive. And on the right-hand side, it's showing you which regions have the most problems in terms of negative outlooks versus positive outlooks. And what you can see there is, unfortunately, Latin America has taken over from the Middle East and Africa in terms of the region with the most negative outlooks. There are no countries on positive outlook in Latin America. There has not been a positive rating action in Latin America in 4 or 5 years. That's a long time with no positive rating actions, all negative. And if you look at the outlooks now, it suggests that the ratings are coming down in the future at a faster rate than anywhere else in the world, and unfortunately at a faster rate than they have at any time in LATAM history. So if you compare Latin America today to the other regions, it's worse. If you compare Latin America today to its own history on the rating side, it's worse. So there's a lot of kind of fundamental issues that are at play across the region, not very positive in terms of the rating outlook at all. And this is when the world economy is still growing, don't forget. So we're not yet in a recession in the US. So there's potential downside risks to some of the issues that are facing Latin America as well. So negative yielding debt, I'll talk about this for a second or two. So there are now how many do we have? 9 sovereigns globally, where the 10-year bond yield is below zero. It's kind of hard to wrap your mind around that idea, that you can issue 10-year debt and the yield is negative at issuance. So governments, the more debt they issue, the more money they can make. It's bizarre that you can solve your fiscal problem by issuing more and more debt, which is very strange, but shows you how bizarre the markets are at this point in time. So we put out a piece last week which said, don't be fooled by negative rates to think that this is telling you that everything is fine in the world of sovereign credit. Everything is not fine in the world of sovereign credit. What this is telling you is that central banks around the world have distorted bond markets, largely in Europe, but also in Japan and to a lesser extent in the United States, to the point where yields have been pushed lower and lower, and the market has taken them into negative territory. So there's now around $15 trillion of government debt with a negative yield attached to it. 15 trillion. The entire stock of government debt is around 66 trillion. So almost a quarter of all debt issued by all governments around the world is trading with a negative yield attached to it. That's an enormous market distortion. So is this good news or bad news from a credit perspective? So I've got a couple of bullet points there. Certainly lowers the interest service burden. So governments have to pay a lot lower interest rate when it's either at zero or in negative. So that's a positive. You get better government debt dynamics. So you should have declining debt based on that factor alone. So those are the two positives. The negative factors are on the right-hand side. In most cases, in fact, I could say in all, but I won't say in all because I haven't checked every single number, but it's pretty close to being in all. They've already spent the interest savings. So whatever government saved on the interest payments, in Europe, they've spent it 3 or 4 times over. Several times they've spent the interest savings. And we estimated that governments in Europe saved something like €1 trillion when interest rates started to fall and the ECB said they would do whatever it takes. So they've spent that. They spent 3 or 4 trillion. So the money's gone already. If we think it's structural factors that are pushing interest rates lower, and this is why central banks are really worried, then we should be concerned about growth. So that cannot be positive for the medium term. If central banks are worried about productivity growth and don't see anything allowing them to raise rates, that is not a positive for medium-term growth. And then the last point is that with interest rates at this level, or at these levels, it just encourages more borrowing by governments, many of which are already heavily indebted. So from a rating perspective, I think the negatives outweigh the positives. And you can see the countries at the top. It's not all just AAA countries. We've got AAA countries, we've got AA countries, even single A countries where the 10-year yield is negative. So the world is well and truly upside down. So trade war, China-US trade war. What do we think of this? Well, the chart on the right-hand side just shows you export growth in the top half, import growth on the bottom half. What I'm trying to show you here is that the reduction in import growth that we've seen over the last year or so is more evident in emerging markets than in developed markets. So when we think about the slowdown in trade, it's actually a slowdown in imports into emerging markets. So that's a fact to keep in mind. But where do we think the trade war is going to go from here? 4 things we think are worth paying attention to with respect to where you think it's going to go. Number 1, China is not in any hurry to go back to the negotiating table. Why would they be in a hurry? They have they don't have the same amount of political pressure that President Trump has. He's the one with an election next year. There are no equivalent elections in China. They've got time on their side. If he's the ultimate deal maker, and this is his ultimate deal, he needs to reach some kind of agreement next year. China doesn't. So they're just going to play this very slowly, play for time, and as they get closer to the election in 2020, That puts more pressure on the United States to come up with compromises more than the Chinese. So that's one thing. China will want to slow it down. Not completely stall it, because when they stall it, then Trump imposes more tariffs. So they need to have it known that they're in good faith negotiating, but not too quickly. Point one. So the second point is that the criticism, and we're already seeing this, criticism of the administration in the United States will be growing. It's already growing because people are starting to see the negative effects on economic growth that the trade war is bringing. So initially, there was a lot of enthusiasm in the U.S. corporate sector because many companies that interact with China believed that the issues that the president was trying to get the Chinese to address were problems that they had faced for years: forced technology transfer and intellectual property theft. Those are issues that many American companies that operate in China have been dealing with for years. So there was a lot of support, actually, for the U.S. administration to finally address these issues. That support is now wavering a little because they're seeing the economic implications of getting this resolved are meaningful. And what Brexit has taught us is that when you have internal disagreements, these are bad for confidence, and we think that this is impacting the investment sentiment. So that chart I showed you earlier about investment spending, part of that lack of confidence is really around the trade issues and the confidence that the administration is going to resolve this. So that's the second point. More internal fighting in the U.S. over trade policy, and of course the Chinese will just sit back and let that happen. Third point, there's going to be more talk about exchange rate intervention. So this is where the president has opened up a new policy option, which has not been used in the United States for many years or in any advanced economy, is explicit exchange rate intervention or an explicit exchange rate policy, other than successive administrations talking about strong dollar. So he's already made it clear that he's not happy with the Federal Reserve on interest rates, but what most people don't really appreciate, I guess, in terms of U.S. policy is that while interest rates are, the Federal Reserve is in charge of interest rates, it's the Treasury Department that's in charge of the exchange rate. The Treasury Department is part of the administration. That's part of government. So ultimately, that reports up to the president. So he does not need the agreement of the Federal Reserve to engage in a different kind of exchange rate policy. So there's already a lot of discussion around this issue. You can read a lot of research around how would this happen, how would it happen if they wanted to do it, how effective would it be, et cetera. Expect to see more of that going forward. And then the last point is that what we see happening in the US, where one could argue that trade policy is being used for a number of foreign policy objectives. And you've seen the administration use tariffs against Mexico and a number of other countries for foreign policy objectives. We're going to see more and more countries do the same thing. And the best evidence of that is now a trade dispute that's going on between Japan and Korea, which is getting uglier by the day. Doesn't really get reported a lot outside of Asia, but it's quite nasty, and it goes back to World War II grievances. So this is foreign policy issues showing up as trade policy. So you need to be mindful of that. So those are the four things we would say to watch in terms of trade. So what matters for emerging markets? Well, the dollar matters. So this chart is showing you year-over-year growth rates in emerging market exports and the year-over-year change in the value of the dollar. And you can see there's a pretty strong correlation between these two things. So when the dollar strengthens, as it has recently, emerging market export growth in dollars weakens, which is weird because you think, well, depreciated currency, you should get an export boom from a depreciated currency. There's two reasons really why this doesn't work. That could work on an individual country basis, but it doesn't work across the board for emerging markets as a whole. One reason is that emerging markets as a whole are exporters of commodities. And so when the dollar strengthens, commodity prices tend to weaken. That's a historical relationship that goes back forever, primarily because commodities are priced in dollars. And the second reason is simply that if you get a bump in exports in emerging markets in local currency terms, when you convert that into dollars, that depreciation can actually result in still lower dollar income. So exports can actually be 10% higher, but the dollar value of those exports, if the currency is depreciated by more than 10%, is going to be lower. So the dollar really matters in a number of different ways, and this is one way to look at it. So from a Latin America perspective, what matters? Is it China or is it the US? Well, it depends where you sit. On the left-hand side, this is showing you where the countries that are exposed to China. So no surprises, it is Brazil, it is Chile, and it is Peru. So at least a quarter of their exports are going to China. So China matters more than the US to those three countries. And it's growing, right? The share of their exports to China is continuing to grow. The right-hand side, it's showing you exposure to the US. And Mexico is off the chart, so it's up at 80%. That's really the only market that matters. And then you've got Colombia. Actually, the trend is lower, but the number is still quite high. So for Argentina, you can see the blue line, it kind of runs along the bottom, not really exposed to either one of these markets directly in a meaningful way. So it's more of a Brazil story for Argentina. So when we think about global growth and the impacts of global growth on the region, for some countries it's China, for some countries it's the United States. So when we think about the region or different regions' exposure to the dollar, here's another way to look at that. This is borrowing in US dollars, either domestically from your banks here or externally from banks or bond markets abroad. And so on the left-hand side, it's showing you different regions. And this is just the private sector. There's no government in here. This is just really corporates and households, which is mostly corporates. And on the left-hand side, you can see that the region which is now at the highest in terms of dollar exposure, dollar borrowing, is Latin America. So the number here is $1 trillion. And it's kind of leveled off, but it's higher than other parts of the world. Asia is higher if you add up China and all of the other countries in Asia, but the Chinese numbers are a little bit distorted. You can see that the China numbers actually decline. They don't decline, there was just a different classification. So what they used to call corporate debt is now government debt. So that's why you get the decline in corporates. But the point of the chart is to show you that Latin America is still the home of dollar borrowing and still exposed to the value of the exchange rate. It's not just an Argentina problem, it's a region-wide problem. On the right-hand side, it's breaking down that Latin America number into the different countries. So Mexico is up top, but you could argue that, you know, with the exposure to the US, maybe it makes sense to be closely linked to the dollar. And I guess the other line which is worth looking at is the Argentina line, which goes the blue line again at the bottom. So the big jump in dollar debt, this is not the government, this is the private sector, this is corporate Argentina. Gone from and households, gone from 43 billion US dollars in 2016 to 130 billion by 2018. So that exposure to the exchange rate and the macroeconomic implications of a depreciation just got bigger with this kind of borrowing in foreign currency in Argentina. So last couple of slides, I mentioned politics in geopolitics. So these are the ones, I guess, that we're focused on now. Brexit, October 31st is the new deadline. The new government in the UK is talking about leaving deal or no deal. We may get an election before that, so it's not clear whether October 31st will be a real deadline. So there's still, even though we're getting closer to October 31st and closer to Brexit, we're still no closer to knowing what it means and whether they'll leave with a deal or without a deal, with this government, a different government. It's still a mess. So we have a negative rating watch on the UK's rating. Turkey, we put it up here not because there's an election coming up. We've just gone through elections in Turkey, and it's a country that was compared a lot to Argentina in the last 2 years because of the currency pressures. The rating hasn't suffered nearly as much in Turkey. You've had a big bounce back on the external side. Haven't quite had that same good fortune here. The politics is, I wouldn't say it's stable in Turkey. Like I said, the election has already happened. It's clear who won. But there is a lot of political pressure on the president, and that we think is something to watch going forward. Argentina, I'll come back to in a second. Italy, we have on a negative outlook as well. This, we don't think the government is going to survive, and so that was consistent with what's happened in the last week when one of the deputy prime ministers pulled the plug on the coalition, so look for some turmoil and some political noise there. Mexico, well, AMLO is certainly popular with households, but not with businesses. You can see there's two different opinion polls that you can look at in terms of confidence. And we think that the macroeconomic implications are really going to be a little bit more negative going forward because investment spending is under some pressure. And a new entry on the political risk slide is Hong Kong, where I'm based. So maybe I'm a little bit biased here, but some damage already being done in Hong Kong, and look for more, I think, going forward. On Argentina, I'll just close with this slide here, which shows you just how the ratings have moved in Latin America over the last several years. And as I mentioned, it's been a while since we saw any kind of positive rating action or any upgrades in Latin America. It was 2014, 2015. Since then, ratings have been moving sideways or lower. So, while the world has actually been in a reasonable position from an economic growth perspective, Latin America has not benefited from that. The ratings have been pushed down. And in Argentina's case, it's the one at the bottom, the blue line at the bottom, back down to what we call on the left-hand side C/D. So it's actually triple C. So we have triple C, double C, single C. So Argentina is at triple C. So we took it from B to triple C. So for us, that's a 2-notch. It goes from B to B minus to triple C. So it's a 2-notch downgrade. I know it's been reported a lot that it's been 3 or 4 notches, but it's 2. It's 2 notches. So why did we do that? Well, 2 reasons. The heightened policy uncertainty following the PASO elections. So we, like everyone else, were surprised by the outcome of those elections, and we think that poses some risks to the macro policy outlook post-elections, because now it looks like we may get an election result that we had not been anticipating with our single B rating. And the second one, there's now an expected deterioration, we think, in macroeconomic performance. I showed you the GDP growth number previously that we now have at minus 2.5 for this year. That's going to put more pressure on public finances. The president has already announced some measures to put additional downward pressure on public finances. It's going to be a little tricky how some of those tax cuts work with the provinces as well. So there's a federal fiscal issues to think about. And so we believe in this environment at triple C for us means that some kind of restructuring or default, the way we define triple C is that a restructuring or a default is possible. We're not saying it's probable. If we thought it was probable, we would have a double C rating. So we're saying it's triple C. So we think there's a heightened risk around the debt profile of the government. So it's possible. So when we think about triple Cs, there's only a couple of other triple Cs in the world now. There's Zambia and there's Congo. So we're at the very bottom, really, of the rating scale. And when you think about the depreciations of a size that Argentina has experienced over the last year, So we did some research several months ago to look at other countries' historical experience with depreciations of that magnitude. So we looked for a 30% depreciation versus the dollar, and something that stayed at that depreciated level for at least a year. So not a fast depreciation and then a fast recovery. Countries can work through that, but a depreciation in a currency that just didn't come back. And so we went back to the year 2000 to look for examples of that. There's not that many, and a couple of them have happened here in Argentina. And when we looked at, we found since 2000, 16 episodes of currencies depreciating by 30% or more, in that depreciation lasting for 12 months or more. And in 5 of those episodes, the sovereigns have defaulted. So 5 out of 16. So we're not saying it's probable, we're saying it's possible that Argentina defaults based on what we've seen other countries go through, including Argentina, facing depreciations of that size. And for those countries that had those kinds of depreciation pressures, the average decline or the average reduction in the rating was 2 notches, which is exactly what we've seen in Argentina up until now. One last point in terms of external funding pressures, which gets the topic of discussion, I guess, in Argentina. One thing which is important, and this was alluded to during the conversation, the panel discussion previously, but I just want to really clarify this point, which is if you look at the current account deficit in Argentina last year, we've got a $28 billion. So that's $28 billion that Argentina, $28 billion worth of funding that Argentina has to come up with, external funding. But when we look at the capital flows in Argentina last year, and you think about market confidence and investor confidence in Argentina, really the biggest issue on the capital flow side is Argentine residents' capital flows. This is not foreign residents putting money in Argentina and taking money out of Argentina. This is Argentine residents taking money out of Argentina. So the current account deficit was $28 billion. Those resident capital outflows were of a similar magnitude, $25 billion or somewhere about in that range. So when we talk about confidence and market confidence, it's not somebody sitting at a terminal in New York who's deciding whether they like or don't like Argentina, or they're confident in Argentina or not confident in Argentina. It's people who live here, who that is one of the biggest sources of the capital moving in and out of the country. So when we think about confidence, and we've heard some remarks from the central bank governor and the new minister this morning, trying to instill that confidence. He's not trying to instill that confidence necessarily in people sitting in New York. He's trying to instill that confidence in people sitting right here. So I think it's an important thing to remember that the capital flows issue is really, first and foremost, an Argentine issue. So that's the end of my remarks. I'm more than happy to take any questions in either language, and Douglas will translate for me because my Spanish isn't good enough. So thank you very much for listening.
Bueno, no sé si hay preguntas. Okay, first question. When are you going to upgrade Argentina? No, it's a joke. What is your view on Argentina's most important creditor, the IMF?
Yeah, we'll start with the easy stuff, I guess. Yeah. Look, when we think about the IMF program in Argentina, I think it's important to remember this was not an IMF program. This was Argentina's program, which the IMF signed up to, right? So it's important to keep in mind how we got to where we are today. So I think everyone was quite clear when the program started that the IMF had a relatively light touch and influence on the policy framework. That was the Argentine government's policy framework, essentially, that the IMF signed up for. Look, now the program here is enormous from the IMF's perspective, right? Not just enormous from the government's perspective, but it's also enormous for the IMF. So they clearly want to tread very carefully. I would have to assume that they have no interest in pushing Argentina into a crisis. That's, think what you will about the IMF, but that's not what their mission is, has ever been. So they have no interest in trying to do that. They have an interest in trying to help Argentina through this. I suppose one question that people outside of Argentina ask about the relationship between the fund and how it could go bad is the IMF can only lend money into a country that it determined is whose debt they determine to be sustainable. So if the IMF reaches a conclusion that they look at a country's money going into a country, money coming out of a country, and if the numbers don't add up, the IMF cannot lend money to that country. And that is how the IMF can suggest or request a debt restructuring of a country. That the IMF will only lend to that country if they restructure the debt to make the external balance sheet viable. And so there's a lot of discussion amongst analysts globally that will the IMF, in its upcoming mission, which is imminent, will they conclude at the end of that mission that the debt here is not sustainable? And will they essentially force the government into a restructuring? So I think that's something that people outside of Argentina are looking at quite closely. I don't know what the IMF is going to conclude at the end of their visit, so I'm not going to tell you that I have any idea of what their conclusion is going to be. But one example that people have used for the IMF going into a country prior to an election and having to make a decision like that, one example is Ukraine. So Ukraine was in a very similar position, an election coming up, the IMF coming to town. Gosh, is the debt sustainable or not? The IMF deferred the decision. They didn't want to get involved in the politics to help one side or the other, and just waited until after the election was over. I'm not saying that's what they're going to do this time. But look, it's a complicated time for the IMF with the amount of money on the table here in Argentina and the precariousness of the external finances at this point. Not easy. But like it or not, Argentina and the IMF are going to be partners for some time, given the size of this program.
Thank you. Do you think inverted yield curve indicates coming recession?
This is quite a common question, I guess. How should we say it? Most recessions have been preceded by inverted yield curves, so people conclude that an inverted yield curve, therefore, will lead to a recession. Couple of things. One is the time between the inversion and recession can be quite long. It could be 2 years. Well, eventually, we will have a recession in the US, and we've just had an inverted yield curve. So those who believe that it is preceding a recession will eventually be proven correct. There will be a recession, and we've had an inverted yield curve. But did one contribute to the other? I would say the reason why we think it's different this time is because usually an inverted yield curve is because short-term interest rates are rising quickly. So you get short-term interest rates moving up, and longer-term interest rates moving down because there's a lack of confidence in the economic outlook, and longer-term bond yields start to come down. The expectation in the market is that eventually policy rates will come down as well. So that pushes lower rates down. So you got lower rates down, shorter rates are too high, essentially, and so you get this inversion. We're not really in that predicament today. It's hard for anyone to argue, well, maybe Mr. Trump argues, but it's hard for anyone else to argue that short-term interest rates in the US at these levels are too high. So we don't think this is a normal kind of yield inversion. We think it's a yield inversion because, largely because of what central banks elsewhere have been doing in terms of quantitative easing. So it's an explicit policy objective of the Bank of Japan to have 10-year yields very close to zero. So when you have one of the world's largest bond markets with that as an explicit objective, you're pushing rates down to zero. The ECB, we think, will be involved in quantitative easing again as early as next month, in September. So you've got central banks pushing yields lower. So that we think is contributing to that inversion in the curve. So no, we don't think it necessarily means a recession in the US is coming. I would point you to those charts I showed earlier. Look, watch US investment spending, because that's the key thing.
With rates coming down and with quantitative easing going on, do central bankers have a margin to do anti-cyclical policies in the future?
Yeah, good question. So how many tools do they have? People have started to talk in the US, not the Fed, but people in the private sector in the US have started to talk about the possibility of negative yields in the US, which is kind of unthinkable up until now. Look, you know, there's only a couple of instruments central banks have, right? You can lower interest rates, and now we know they can put interest rates below zero, which was previously unthinkable. They can manipulate the exchange rate, which we haven't really seen in recent years and don't really still expect to see. Beyond that, there's limited things. They can do quantitative easing. So those are kind of the three things that they can go to. So I think we're probably going to see some mix of quantitative easing and lower rates, maybe some kind of exchange rate policy adjustment, but the onus in terms of counter-cyclical policies is really with the fiscal authorities. And so, you know, central banks will be looking to governments because typically, you know, pressures for stimulus come from politicians more than from central bankers. And so the central banks will be pushing it back to the politicians saying, look, you guys if you want stimulus, organize it yourselves, because, you know, our balance sheets are large, interest rates are zero, we've done our part. So, you know, I think the dialogue between central banks and governments is going to be interesting to watch going forward.
In your view, will negative yields on sovereign bonds be a risk for larger fiscal deficits?
Yes, we're already seeing that. So the interest costs go down, as I mentioned earlier, but governments have already spent the money. They've spent it several times over. So yes, there's very little doubt that lower interest rates probably leading, not in every single case, but in most cases, and if you aggregate countries, you would see that lower interest rates has not really meant a better fiscal performance, probably a slightly worse fiscal performance. And of course, they're more comfortable borrowing at these kinds of levels. So it just encourages larger deficits and increases in debt. So yes.
In light of potential recession in the United States, do you feel that there will be a drop in inflation?
In the
US?
In the US. That would seem, logical to have lower inflation rates in the US. You know, the inflation rate in the US is not really that far off the Fed's target. So the Fed's preferred inflation gauge is called the PCE deflator. It's not the headline inflation number. It's a variation of that. They want to keep it at or about 2%, and it's pretty close to 2%. So the U.S. doesn't have a deflation problem or very low inflation. But yes, if there were an economic downturn or a recession, then that inflation rate in the U.S. would probably go down. Yes.
One more question, because we're on time and we have a lot more questions coming in. You probably touched base on this, but perhaps you want to comment on this question. Why did Fitch lower the rating 2 notches instead of 1?
Yeah, okay, well, 1 notch would have brought us down to B-, but the reality is part of the conversation now is whether or not there's going to be a debt restructuring in Argentina. If we're talking openly about the possibility of a restructuring, then we're no longer in the B range. We are in the C range. I know we're the only agency now in the triple C range. But when restructuring is part of the conversation, that's what puts you into the triple C range. So we didn't think B minus quite captured the risks here in Argentina.
Okay, I have plenty of other questions, but in order to allow the audience to continue with their activities, I'm going to cut it as it is. I think it's been very interesting, very to the point, and very transparent. So thank you very much for your time, and thanks the audience for such a wonderful moment. Muchas gracias a todos, hemos pasado un buen momento. Ahora tenemos que salir, ¿no? Y encontramos los problemas. Pero creo que tanto para Fix o Fitch es un gusto haberlos tenido acá, y como siempre nuestro más preciado valor es la transparencia y la información, así que estamos a disposición. Muchas gracias a todos.